Hey traders, Rainer Teo here. Today we're diving into momentum oscillators, tools that reveal the speed and strength of price moves. Think of momentum like a car. Is it speeding up or slowing down? These indicators help you spot that in the market. Why does this matter? Because momentum oscillators can signal when a trend is running out of steam or about to reverse. They typically move between set levels like 0 and 100, or oscillate around a central line. When they hit extreme levels, it can mean the market is overbought or oversold. Key moments for traders: the most popular oscillators, the Relative Strength Index, RSI, and the Stochastic Oscillator. Each measures momentum differently, but both aim to show if a price move is strong or weak. Understanding this can be the difference between a winning and losing trade. In this video, we'll focus on the Stochastic Oscillator and the RSI. We'll break down how they work, how they show overbought and oversold conditions, and most importantly, how you can use them together. Combining tools often gives you stronger, more reliable signals. My goal is to make this easy to understand, especially if you're new to trading. So, let's get started and see how these indicators can boost your trading. Momentum oscillators are your window into the market's energy. They help you gauge if a trend has legs or is about to stall. With the right knowledge, you can spot potential turning points before most traders do. Ready to learn how to use these tools for smarter trades? Let's jump in and uncover the secrets behind momentum oscillators. By the end, you'll know how to read the market's pulse like a pro. Stick with me, and let's make momentum your trading edge. Let's get started. Here's what you need to know. Let's break down the Stochastic Oscillator. Developed by George Lane, it compares a security's closing price to its price range over a set period, usually 14 periods. In an uptrend, prices close near their highs. In a downtrend, near their lows. The stochastic makes this relationship clear. It's made up of two lines, %K, the fast line, and %D, a moving average of %K, the slow line. Both lines move between 0 and 100. When the stochastic is at 80, the price closed near the top of its recent range, showing strong buying momentum. If it's at 20, the price closed near the bottom, indicating strong selling momentum. The stochastic doesn't follow price or volume directly, it tracks the speed of price movement. Momentum often shifts before price does, so this indicator can give early signals. Traders watch for crossovers between %K and %D, and for moves into overbought, above 80, or oversold, below 20 zones. Divergences, when price makes a new high but the stochastic doesn't, can warn of a trend losing steam. You don't need to calculate it yourself, your charting platform does the math. The key takeaway: the stochastic helps you spot when momentum is slowing, often before price reverses. It's a simple concept, but powerful in practice. Use it to identify potential turning points and time your trades better. We'll dive deeper into signals and strategies soon. Remember, it's all about where the price closes within its recent range. Now let's look at the RSI, the Relative Strength Index. Created by J. Wells Wilder Jr., the RSI measures the speed and change of price movements. It oscillates between 0 and 100, using a single line for simplicity. The RSI compares recent gains to recent losses over a set period, usually 14 periods. If gains outweigh losses, the RSI rises, showing strong buying pressure. If losses dominate, the RSI falls, indicating selling pressure. Traders use 70 and 30 as key levels. Above 70 is overbought, below 30 is oversold. Overbought means the asset might be due for a pullback. Oversold suggests a potential bounce. These aren't automatic buy or sell signals. They're alerts to pay closer attention. The RSI is straightforward and widely available on charting platforms. It gives a different perspective than the stochastic, focusing on the ratio of up moves to down moves. Both tools are useful, but they measure momentum in slightly different ways. Understanding these differences helps you choose the right tool, or combination, for your trading style. The RSI is great for spotting when a market is stretched too far in one direction. Use it to confirm trends or spot potential reversals. Let's see how these signals work in practice. Let's compare how the stochastic and RSI spot overbought and oversold conditions. The stochastic flags overbought above 80 and oversold below 20. The RSI uses 70 for overbought and 30 for oversold. The stochastic is more sensitive, giving more frequent signals. Great for short-term traders, but it can produce more false alarms in choppy markets. The RSI is smoother, often staying in extreme zones longer during strong trends. Fewer signals, but potentially more reliable. Neither is better, they just offer different perspectives. Use these levels as guidelines, not hard rules. Always confirm with price action or other indicators before trading. The stochastic's rapid moves can help you catch quick reversals. The RSI's steadiness can help you ride trends longer. Understanding their differences lets you pick the right tool for your strategy, or, better yet, use them together for stronger signals. Next, let's see how these indicators work on real charts. Let's see the stochastic oscillator in action on a daily chart of XYZ Corp. We add the stochastic with a 14-period setting and watch for %K and %D to enter overbought, above 80, or oversold, below 20 zones. Suppose XYZ is in an uptrend and the stochastic moves above 80. This signals strong buying but also warns of overbought conditions. Don't sell immediately, instead watch for %K crossing below %D while still above 80. This crossover can signal fading momentum and a possible short-term pullback. In a downtrend, if the stochastic dips below 20 and %K crosses above %D, it could signal a potential bounce. Use these signals as alerts, not standalone trade triggers. Always consider the broader trend and look for confirmation. The stochastic is great for timing entries and exits within your trading plan. It highlights when price may be stretched too far in one direction. Now let's see how the RSI works on the same XYZ Corp chart. Apply the RSI with a 14-period setting and watch for moves above 70 overbought or below 30 oversold. If the RSI climbs above 70 during a rally, it signals strong buying, but also warns the move may be overextended. In strong trends, the RSI can stay overbought or oversold for a while, so don't act on these levels alone. Look for confirmation. Does the RSI quickly drop back below 70, or does it form a bearish divergence? Price makes a new high, but RSI makes a lower high. This divergence is a classic sign of weakening momentum and a possible reversal. In a downtrend, if RSI drops below 30, watch for a move back above 30 or a bullish divergence. Price makes a new low, but RSI makes a higher low. These signals suggest selling pressure is easing and a bounce may be near. The RSI excels at showing when momentum is truly exhausted. Use it to confirm if a market is at an extreme. Let's see how combining these tools can improve your trading. What happens when you combine the stochastic and RSI? Using both can filter out false signals and give stronger confirmation. For example, if the stochastic is overbought above 80, and the RSI is also overbought above 70, the odds of a pullback increase. Look for agreement. When both indicators signal overbought or oversold, the signal is stronger. Double divergences, when both show divergence from price, are powerful warnings of a trend reversal. The stochastic, being more sensitive, may alert you first. The RSI can confirm the move. Don't expect perfect alignment every time, they're different tools. Use the stochastic for early alerts and the RSI for confirmation, or wait for both to hit extremes before acting. Experiment to find what fits your style and market. Combining these tools refines your entry and exit timing. It's about stacking the odds in your favor. Let's weigh the pros and cons of the stochastic next. The stochastic oscillator has clear strengths and weaknesses. Its main advantage is sensitivity. It reacts quickly to momentum shifts, giving early signals for reversals or entries. This is great for short-term traders who want to catch moves early. The overbought 80 and oversold 20 levels are easy to spot and widely used. Crossovers between %K and %D offer clear entry or exit triggers. It's also excellent for spotting divergences. When price makes a new high but the stochastic doesn't, it can warn of a trend change. However, its sensitivity can be a drawback in choppy markets, generating many false signals. The stochastic can whip between extremes, leading to confusion if used alone. It's not a standalone solution. Combine it with trend analysis or other indicators for best results. Divergence signals are often more reliable than simple overbought or oversold readings. Use the stochastic to spot when a move is losing strength, but always confirm before acting. It's a powerful tool, but not a holy grail. Practice interpreting its signals in different market conditions. Combine it with other analysis for smarter trades. Let's wrap up with some key takeaways. Here's what you need to remember about the stochastic and RSI. Both are momentum indicators. Stochastic focuses on closing price within its range. RSI compares average gains to losses. Overbought and oversold levels are alerts, not automatic trade signals. In strong trends, these conditions can persist. Don't rush to trade against them. Use these levels to pay closer attention and look for confirmation, like crossovers, divergences, or price patterns. Combining stochastic and RSI can filter out noise and increase signal reliability. The stochastic is more sensitive, the RSI is smoother and often more reliable in trends. Use them together for a well-rounded view of market momentum. No indicator is perfect, both can give false signals, especially in sideways markets. Always use them as part of a complete trading plan including risk management and market context. Practice on a demo account to see how they behave in real markets. The more you practice, the better you'll get at interpreting their signals. Keep learning, keep testing, and trade smart. Momentum oscillators are powerful allies, use them wisely. Thanks for watching and happy trading.